Okay, welcome you all for our Zoom live meeting in which we talk about our last lecture, which is short-term investments and account receivable. So right now, what we are trying to do, we are explaining how we are recording our balance sheet, right? We finish first part, cash and cash equivalents, and now we have finished short-term investments and account receivable. Our next agenda would be we're going to talk about some other stuff like inventory, and then we're going to close down our current assets. Then we will move toward the fixed assets, which is plant, equipment, and property. And then we move toward the liability side, which is long-term debt, and then equity. And then we're going to finally concluding our this principle of accounting, and then we're going to have our final. So the agenda of number one is that when is the final? So due to my illness and my sickness, I got hospitalized for 10 days because I got typhoid, and I had to go to the hospital and admit over there because it reoccurred, and I was not able to speak properly, and I was so weak at that time. So thank you guys, you supported me well, and you wished me your best luck. So that's why I want to talk about it. So my other course, which is microeconomics, we already talked about over there, and we extended it to the mid of the July. So I hope by mid of the July, we would be ending all our, required lectures. And our final will be either on 15th of July or either on 16th of July. So the exact date we're going to discuss during this lecture in our next, or maybe the second last hour, of the Zoom meeting. We talk about this when the final going to be on 15th of July or 16th of July. So are we clear on this?
Yes.
Yes.
Yeah. Okay. So if you have any question regarding our second topic, which is the questions regarding our previous lecture, which is short-term investments and account receivable. Any question? First of all, I'll start with Michael. Michael, if you have any question regarding our previous chapter.
I'm good.
You all understand that?
Yeah.
Well done. How about Theorina?
With the most part, we have something like cost of recipient accounts. And I don't know
Theorina, I
what it
cannot
was.
hear you properly. Maybe you please remove the hand free and then talk about that, because it's going to be the echo is very loud.
Can you please explain write-off?
Explain?
Write-off.
Write-off, okay. So write-off mean, so first of all, we understand why we create the reserves. The answer to this question, which I already explained thoroughly in our lecture, that it is a smart management for the manager, because we are not talking about just accounting manager, but also the responsibility is to predict the future as well, right? It's not just recording itself. So when we talk about the predictability of future, and then we forecast. For forecasting, we plan. So we make cash budgets, right? This kind of budgets as well. We will also discuss in our, managerial accounting subject as well. We make a lot of different budgets. So why we create or why we forecast? To plan better for future needs and all the stuff. So for cash budget, the collection from the customers, it plays a pivotal role in cash management and cash budget as well. For that one, the managers are responsible if there is a short in a cash. So this is very, of high penalty or very bad reputation of your business if you present a check or you cut the check on your company name, and the supplier goes and try to cash out and there is no cash in the account. So this is a really bad reputation. It sometimes you have to pay huge liquidated expenses as well in order to fulfill the damage. So in order to maintain that repute, you plan better. The smart managers, they plan better with respect to the collection from customers. So rather, the bad debts, in some books, the uncollectible, they are called bad debts. So if I use bad debts, please do understand that I'm talking about uncollectible. So if uncollectibles do happen, which is reality of the life, because it's not like ideal world right now. Sometimes customers, they are companies, and companies can go bankrupt, or customers, they go bankrupt as well. So you cannot recover the amount from there. Although there are legal procedures, there are securities companies, collection companies, you can contact them, but still there is a chance that if person is insolvent, or it announces its bankruptcy, then everything is you know halt, and you cannot recover anything from it unless his assets or the company's assets are sold, and then you recover some value. Otherwise, it's totally lost. So companies, what they do, they see their history. If company is new, then what is the reason for? So why they are? Oh, sorry. What kind of measures they look to see that whether we should go for percentage of sale, and which kind of percentage of sale, because they don't have sale history. So they take a comparable or benchmark according to their own uh, level of like company. So they benchmark that company, and they take their policies. If that company takes 1%, so they take also 1%. And after when they establish the history, then they're going to talk about, okay, this benchmark take 1% because it's a big one. When we are small, so we have a higher risk, so we can increase our you know this ratio percentage of sale is 2%. And now when actually the bad debt happens, now we are coming towards the write-off. When bad debts happen, then what we're gonna do? Then we're gonna clap for the manager. How? Because cash budget is not disrupted. It's not changed, because we write down that amount which is less than the reserve. So if total customers, collection from the customer from the balance sheet is used to be like 10 million, and allowance is, for example, 100,000. So 9.9 million we showed in our cash collection from customers. So our budget plans, they are not hurt. And where this actual bad debts or actual uncollectibles are charged against the reserve or allowance that we have created. So when the actual bad debts occurs, then who and what is the account that we're going to charge? We charge our bad debts or uncollectibles to allowances, because when we create allowance, we already make it expense. When we create allowance, what is the entry? Expense, uncollectible expense to allowances for uncollectible, right? It means we already expensed it. So when actual thing happens, who is responsible? That contra account of account receivable. So we're gonna charge anything, any actual, or in case of write-off mean when you when actual write-off, when actual uncollectible or bad debt happens, then we charge to which account? Account gonna be used as contra account of account receivable, which is allowances for bad debts. So entry gonna be allowances for bad debt to account receivable, reverse entry, right?
Yes, thank you.
Any other question?
No.
Okay, so today I'm going to be recording our next lecture, and I hope by tomorrow it is finally uploaded on YouTube. I'm going to share the links with you as well. Okay.
Okay,
If there
thank
is
you.
no any
Okay.
question, you are allowed to leave. And I'm going to wait for 5 minutes so that others can join. And if they have other question, I'm happy to answer. Otherwise, meetings is going to be finished.
Thank you. Bye bye.
Thank you. Bye.
Take care. Stay safe.